The number you see on the news, the one flashed across the screen in bright green or shocking red, is almost always a lie. Not a lie in the legal sense, perhaps. It's a number that has been audited, blessed by accountants, and filed with the authorities. But it is a lie in the way a funhouse mirror tells a lie. It reflects a distorted version of reality, a version carefully crafted to be as flattering as possible. This number, this seductive single data point, is called net income, and it is the most dangerous number in the world for an investor. It is the siren song that has lured countless portfolios onto the rocks of financial ruin. We are taught from our first foray into the market to look for it, to celebrate when it's high and panic when it's low. We build our entire framework of valuation around it, with metrics like the price-to-earnings ratio serving as the gospel for generations of investors. But what if this cornerstone of financial analysis was built on sand? What if the very foundation of how we value a company was fundamentally, and perhaps intentionally, flawed? The journey we are about to embark on is a journey into the mind of the most successful investor in human history, Warren Buffett. But this is not about his folksy wisdom or his penchant for cherry Coke. This is about a single, devastatingly effective intellectual weapon he forged in the fires of decades of business analysis. It's a concept he unveiled not in a best-selling book or a primetime interview, but quietly, almost secretively, within the dense pages of his 1986 letter to his shareholders. He called it owner earnings. And this simple, almost rustic-sounding idea is a nuclear-powered lie detector for corporate finance. It is the intellectual acid that dissolves accounting fiction and leaves behind only the hard, immutable truth of cash. Mastering this concept is not just an upgrade to your investment toolkit. It is a fundamental paradigm shift. It is the difference between being a passenger on the chaotic roller coaster of the stock market, tossed about by headlines and analyst ratings, and being the person who owns the entire amusement park, standing back and watching the cash roll in, day after day, regardless of the noise. It is the key to unlocking true financial freedom, not through speculative gambles, but through the methodical acquisition of real, tangible, cash-producing assets. This is the final promise of value investing, the secret handshake that separates the amateur from the professional, the 99% who are perpetually confused from the 1% who consistently build lasting wealth. We will dissect this concept piece by piece until it becomes second nature. We will explore the psychological traps that net income sets for our brains, and how owner earnings allows us to sidestep them. We will walk through the exact mechanics of the calculation, turning you into a forensic accountant capable of seeing what others miss. And we will learn to wield this knowledge not just as a defensive shield to avoid bad companies, but as a powerful sword to identify the true cash kings of the market, the businesses that will form the bedrock of your portfolio growth for years to come. The world of corporate profits is a world of illusion. It is time to see the truth. Our first step on this path requires us to understand the nature of the illusion itself. We must first appreciate the depth and sophistication of the funhouse mirror before we can learn how to shatter it. The concept of net income or earnings seems so straightforward. It's revenue minus costs, right? What a company has made in a given period. But the reality is that the journey from the top line of the income statement, revenue, to the bottom line, net income, is a long and winding road filled with detours, estimates, and judgments made by management. It is less a reflection of objective fact and more a carefully constructed narrative. And no period in modern financial history demonstrated the danger of believing this narrative more than the late 1990s. The story of this era is our foundational anecdote, a cautionary tale written in the language of deceptive accounting and shattered dreams. Imagine it's 1996. The internet is a nascent, crackling thing. But on Wall Street, it's a roaring bonfire. Any company with .com in its name is being bid up to astronomical valuations. The market is a frenzy of optimism, and the fuel for this fire is a steady diet of spectacular reported earnings. In his shareholder letter from that year, a letter that would prove to be eerily prescient, Warren Buffett fired a warning shot that almost everyone ignored. He spoke about a trend he was seeing, a quiet trick of accounting that was allowing companies to manufacture profits out of thin air. He talked about restructuring charges. It sounds boring, a piece of accounting jargon, but its effect was electric. Here's how the game worked. A company, let's take a corporate giant like IBM in that era, would decide to restructure. They would announce a massive, one-time charge against their earnings. They'd say, "We're laying off 10,000 people and closing 3 factories. This will cost us $2 billion this year." The market would often applaud this, seeing it as a sign of management getting lean and mean. That $2 billion charge would crush their net income for that year, making it look like a terrible year. But here was the magic. The company would intentionally overestimate the cost of this restructuring. They might say it would cost $2 billion, when they knew it would only cost $1.5 billion. That extra $500 million didn't just vanish. It sat on the balance sheet in a reserve account, a little pot of accounting honey for later. Then, over the next few years, whenever the company was having a tough quarter and was about to miss Wall Street's earnings expectations, the chief financial officer could dip into this reserve. They could release, say, $50 million from that restructuring reserve and count it as income for the current quarter. Voila! A potential earnings miss is magically transformed into an earnings beat. The headline flashes across the screen: IBM beats estimates by 2 cents a share. The stock price jumps. The executives get their bonuses. And the average retail investor, looking only at that beautiful, manipulated net income number, buys in, completely unaware that the profit wasn't generated from selling more computers or services. It was an accounting ghost, a mere bookkeeping entry conjured from a slush fund created years earlier. This wasn't a small-time phenomenon. Buffett called it a troubling development and lamented that these accounting games were making it, quote, exceedingly difficult for investors to grasp the true economic reality of many companies. He was witnessing in real time the institutionalization of the lie. The dot-com bubble would take this to its logical extreme. You had companies reporting enormous net income figures while their cash balances were plummeting towards zero. They used aggressive revenue recognition policies, capitalized expenses that should have been written off, and played every game in the book. The net income statement became a work of fiction, and investors who believed it were the ones who paid the price when the bubble burst, losing trillions of dollars in wealth practically overnight. This wasn't a failure of capitalism, it was a failure of analysis, a mass delusion, fueled by the collective decision to accept the funhouse mirror's reflection as reality. This is the danger we are up against. It is subtle, pervasive, and backed by the full authority of audited financial statements. So why are our brains so susceptible to this particular illusion? The answer lies in a powerful cocktail of cognitive biases, the mental shortcuts our minds use to navigate a complex world. The primary culprit is the anchoring bias. When we are presented with a piece of information, especially a number, our minds tend to anchor to it, using it as a reference point for all subsequent judgments. The net income figure and its derivative, the earnings per share or EPS, is the first, loudest, and most heavily promoted number in any quarterly report. It's the headline. It's what the analysts on television debate endlessly. Because it is presented with such prominence, our brain latches onto it as the definitive measure of a company's success. Even if we later see evidence of poor cash flow, our initial judgment is already colored by that anchor. We find ourselves trying to explain away the bad news to fit our initial, anchored perception, rather than reevaluating from scratch. This is compounded by authority bias. The financial statements are prepared by the company's management, reviewed by a board of directors, and, most importantly, audited by a major accounting firm. This gives the numbers a powerful aura of infallibility. We think, a firm like Deloitte or PricewaterhouseCoopers has signed off on this, so it must be true. We outsource our critical thinking to these perceived authorities. We forget that auditors are not there to tell you if a business is good. They are there to confirm that the company has followed the rules of accounting. But the rules of generally accepted accounting principles, or GAAP, are a vast and flexible set of guidelines. They allow for a wide range of estimates and judgments. Choosing to depreciate an asset over 10 years versus 20 years, for example, is a management decision that can dramatically change reported net income, yet both choices might be perfectly acceptable under GAAP. Trusting the auditor's stamp of approval as a sign of economic truth is a catastrophic mistake. Finally, we fall prey to what we can call simplicity bias. Our brains are fundamentally lazy. They prefer easy answers to complex problems. Analyzing a company's cash flow statement, digging through footnotes, and trying to estimate future capital expenditures is hard work. It requires effort and nuance. Looking at a single number, earnings per share, and comparing it to another single number, the stock price, to get a P/E ratio is incredibly easy. It provides a clean, simple, and satisfying answer to the question, is this stock cheap or expensive? The financial media and data services cater to this bias, packaging everything into these simple, digestible metrics. The market, in many ways, is a machine designed to give the 99% what they want, simple answers. But in investing, the simple answer is almost always the wrong answer. These three biases, anchoring, authority, and simplicity, create a perfect storm of cognitive failure, making the average investor a willing and eager consumer of the fiction presented in the net income statement. How do we break free? We need a mental model, a structured way of thinking, that acts as a circuit breaker for these biases. Let's call it the journalist's skepticism blueprint. A good journalist never takes a press release at face value. They treat it as a starting point for their own investigation. We must do the same with net income. Step 1 of this model is to invert your process. Instead of starting with the income statement, which is the most heavily massaged of the financial documents, you must make a conscious habit of starting with the cash flow statement. This is where the truth resides because it's much harder to fake cash. The cash balance either went up or down. It's the closest thing to objective reality you will find in accounting. Step 2 is to reframe net income in your mind. Do not think of it as profit. Think of it as management's opinion of profit. This simple change in language is incredibly powerful. It strips the number of its authority and turns it from a fact to be accepted into a claim to be investigated. Step 3 is to always ask the killer question. Show me the cash. Whenever you see a company report a big profit, your immediate, reflexive response must be to find the cash flow from operations on the cash flow statement. Are these two numbers in the same ballpark? If a company reports $1 billion in net income, but only generated $200 million in cash from its operations, alarm bells should be screaming in your head. Where did the other $800 million of profit go? It might have gone into building up inventory that isn't selling, or into receivables from customers who aren't paying their bills. The cash flow statement reveals the truth behind the story. Step 4 is to adopt a rule of trust but verify. Trust that the accountants have followed the rules, but verify the economic reality for yourself by focusing on the movement of actual cash. This mental model acts as a powerful shield. It forces you to engage your analytical brain before your emotional, bias-driven brain can leap to a conclusion based on the seductive headline number. The path of the 99%, the antithesis of this approach, is the well-worn road to mediocrity and often disaster. The typical retail investor operates in a state of financial illiteracy, guided by narrative and emotion. Their journey begins with a headline. They see on their favorite financial news network that a company, let's call it Tech Corp, has just crushed earnings expectations. The stock is up 15% in pre-market trading. This triggers a powerful psychological response, FOMO, the fear of missing out. They don't want to be left behind. They pull up their brokerage app. They see the P/E ratio, let's say it's 20. It seems reasonable, perhaps even cheap, for a tech company. They place a market order to buy, feeling a rush of excitement as they join the winning team. They have just made a significant capital allocation decision based on two pieces of data, a news headline and a single, flawed metric. They never once looked at the balance sheet to check the debt levels. They never opened the cash flow statement to see if the company was actually generating or burning cash. They have no idea what the capital expenditure requirements of the business are. They have, in effect, bought a car based solely on a picture of the speedometer, with no knowledge of what's under the hood, whether the engine is sound or if the gas tank is empty. For a while, this strategy might even appear to work. As long as the narrative around TechCorp remains positive, and the company continues to meet or beat the manipulated earnings expectations, the stock may continue to climb. But the foundation is rotten. The company might be spending more on new equipment each year than it's bringing in from operations. It might be funding its growth by taking on mountains of debt or by constantly issuing new shares, diluting the ownership of existing shareholders like our unwitting investor. Eventually, reality always asserts itself. The cash runs low, the debt covenants get triggered, the growth story falters. And the stock price, which was built on a foundation of accounting fiction, collapses. Our investor, who bought on the basis of a simple story, is left bewildered and angry, blaming the manipulated market or bad luck, never realizing the fault was in their own process. This is the fate of those who worship at the altar of net income. The direct financial connection between this flawed metric and your portfolio is stark and unforgiving. Let's quantify the illusion. Imagine two companies, Company A, Steady Eddie, and Company B, Growth Gamble, both operating in the same industry. Both companies report the exact same net income for the year, $100 million. Based on this single metric, the market might value them similarly. If both have the same number of shares, their earnings per share will be identical. An investor following the 99% path would see no difference between them. But now, let's apply our skeptical, cash-focused lens. We dig into the financial statements. Company A, Steady Eddie, is a mature business with a strong competitive position. On its cash flow statement, we see it generated $110 million in cash flow from operations, very close to its reported net income. We also see that its capital expenditures, the money spent on maintaining and upgrading its factories and equipment, was $30 million. This is a business that, after all expenses and all necessary reinvestment, produced a real, spendable cash surplus of $80 million for its owners. Now let's look at Company B, Growth Gamble. It also reported $100 million in net income, but its cash flow from operations was only $20 million. The other $80 million in profit is tied up in accounts receivable. They've sold the product, but they haven't been paid yet. Worse, we look at their capital expenditures and see they spent $150 million on a massive new factory to fuel their aggressive growth plans. So what is the actual cash result for the owners of Company B? They started with $20 million in cash from operations and spent $150 million. The business had a net cash outflow, a burn, of $130 million. It had to borrow money or sell more stock just to survive the year. So we have two companies, both with reported profits of $100 million. One of them put $80 million of real cash in the owner's pocket. The other one took $130 million out of the owner's pocket. Which one do you want to own? The net income statement told you they were identical twins. The reality, revealed by a focus on cash, is that one is a golden goose and the other is a voracious cash-eating monster. This is not a theoretical exercise. This exact dynamic plays out across the stock market every single day. The ability to see this distinction is the first and most crucial step towards building lasting wealth and achieving genuine financial freedom. It is the foundation upon which all sound value investing is built. Having witnessed the grand illusion of net income, we now turn from the problem to the solution. We turn to the revelation that Warren Buffett laid out for the world in 1986, a conceptual tool so powerful it has underpinned the capital allocation decisions that built the $500 billion empire of Berkshire Hathaway. This is the birth of owner earnings. To truly grasp its significance, we must travel back in time and immerse ourselves in the context of its creation. Our foundational anecdote is not one of a dramatic takeover battle or a stroke of stock-picking genius, but a quiet moment of profound intellectual clarity, immortalized in a letter to his business partners, the shareholders of Berkshire. The mid-1980s was a period of corporate chaos. It was the era of the barbarians at the gate, of hostile takeovers, leveraged buyouts, and financial engineering run amok. The language of business was dominated by talk of depreciation, amortization, and complex accounting rules. In this environment, Buffett saw that investors and even corporate managers were losing sight of the fundamental purpose of a business, to generate cash for its owners. They were being mesmerized by accounting conventions that had less and less to do with economic reality. He saw companies reporting huge profits because of large depreciation charges, a non-cash expense that reduces reported earnings, while in reality, their factories were old and crumbling and would soon require massive cash infusions just to stay in business. He needed a new language, a new metric, to cut through this fog. He found the perfect laboratory for his thinking in a company Berkshire had purchased outright in 1972 for $25 million, See's Candies. See's was a beautifully simple business. It sold boxed chocolates in California. Its brand was powerful, allowing it to raise prices year after year without losing customers. Most importantly, its capital needs were minuscule. It didn't need to build massive, expensive new factories every few years. The existing kitchens and stores, with a little maintenance, could pump out ever-increasing amounts of cash. In his 1986 letter, Buffett finally gave a name to the true metric of profitability he had been using internally for years. He wrote, and it is worth quoting his words directly, "If we think through the characteristics of a business, our analytical goal is to determine whether the company's long-term economics are favorable, and if so, how management is deploying the cash that is being generated. But the first question is, what is the cash that is being generated? It is not net income. The number we are looking for is what I call owner earnings." He then laid out the definition that would change the game for serious investors. He explained that owner earnings represented the cash that was truly available to the owners of the business, the cash they could, in theory, pull out of the company at the end of the year without harming its long-term competitive position and unit volume. It was the answer to the simple, profound question, as an owner, how much cash did my business give me this year? This was a radical departure from the academic and Wall Street consensus. It ignored the elegant but flawed structure of the income statement and replaced it with a practical, common-sense test rooted in the reality of a private business owner. The creation of the owner earnings concept wasn't just a new formula, it was a philosophical statement. It was a declaration that the purpose of sophisticated financial analysis was not to get lost in complexity, but to find simplicity, to arrive at a single, honest number that represented the true fruits of the enterprise. The psychological principle underpinning this revelation is one of the most powerful tools for clear thinking, first principles thinking. Instead of reasoning by analogy, i.e., everyone else uses the P/E ratio, so I should too, first principles thinking involves breaking down a complex problem into its most basic foundational elements and reassembling them from the ground up. The accepted truth in finance was that profit was defined by GAAP net income. Buffett rejected this. He went back to the absolute basics. What is a business? It is an entity that takes in cash and pays out cash. What is the goal of owning a business? To receive more cash from it than you put into it over time. Therefore, the only logical way to measure its success in a given year is to measure the cash it has made available to its owner. Everything else, depreciation schedules, amortization of goodwill, one-time charges, is just noise. He stripped away decades of accumulated accounting dogma to get back to the elemental truth of commerce. This approach is a direct antidote to the powerful force of conformity bias, also known as the herd instinct. The vast majority of market participants use net income without question, because everyone else uses it. It's the accepted standard. To question it is to deviate from the herd, which is a psychologically uncomfortable and often professionally risky thing to do. An analyst at a major investment bank who presents a valuation based on a self-calculated owner earnings metric, rather than the standard EPS, would be seen as an eccentric. Yet, this very willingness to deviate from the crowd, armed with a superior analytical framework, is the source of all-out performance in investing. Buffett's genius was not just in his ability to do the math, but in his psychological fortitude to trust his own first principles reasoning over the thunderous consensus of the entire financial world. He built a fortress of logic that was immune to the pressures of conformity, and owner earnings was one of the key cornerstones of that fortress. By adopting this way of thinking, we are not just learning a new formula, we are training our minds to think independently, to question assumptions, and to build our financial decisions on a foundation of bedrock logic rather than the shifting sands of popular opinion. To make this powerful concept practical, we need to translate it into an applied mental model. Let's call it the private owner blueprint. This is a thought experiment you must conduct before analyzing any potential investment. Step 1. Erase the stock ticker from your mind. Imagine that you are not buying a few shares of a company. You are buying the entire company. You are taking it private. There is no stock market to sell your shares on tomorrow. You are stuck with this business, for better or for worse, and your only source of return will be the cash it generates. This immediately and dramatically changes your perspective. You are no longer a speculator on a stock's price. You are the owner of a business. Step 2. Your goal as the new sole owner is to figure out your annual salary from this business. How much cash can you take home without crippling the company? You open the books. You see the reported net income, but as a savvy owner, you know this is just an accountant's opinion. Step 3. You ask the two fundamental questions of ownership. First, how much cash did the business's actual operations bring in the door? This is your cash flow from operations, a line item on the cash flow statement. Second, how much of that cash did IDIBE spend on replacing worn-out machines and upgrading technology just to keep the business competitive and maintain its current level of sales? This is your maintenance capital expenditures. Step 4. You perform the simple, beautiful subtraction. The cash that came in, minus the cash that timeshed out to go out. The result is your paycheck. That is your owner earnings. It is the real, tangible surplus the business generated for you, its owner. This mental model forces you out of the abstract world of stock tickers and PE ratios and into the concrete reality of business ownership. It transforms your entire analytical process from a passive academic exercise into an active, engaged assessment of a company's cash-generating engine. It is the framework that allows you to start thinking like Buffett. The antithesis of this owner's mindset is what we can call the stock renter mentality. This describes the path of the overwhelming majority of market participants, the 99%. A stock renter does not think of themselves as a part owner of a business. They see a stock as a temporary vehicle for capital gains. Their vocabulary is not that of a business owner. Words like cash flow, return on capital, competitive advantage, but that of a speculator, momentum, chart patterns, analyst ratings, beating the quarter. The stock renter is obsessed with the quarterly earnings ritual. They are glued to the screen, waiting to see if the company beats or misses the consensus EPS estimate by a penny. Their decision to buy or sell is triggered by this news. They are essentially gambling on the short-term psychological reactions of other gamblers. They have no concept of the underlying value or cash-generating power of the business. They are simply renting the stock, hoping to sell it to someone else at a higher price before the story changes. This approach is intellectually lazy and emotionally exhausting. It requires constant monitoring of news and price action. It leads to high transaction costs from frequent trading. And most damningly, it completely decouples the investor's fate from the long-term success of the underlying business. The stock renter can own a piece of a wonderful company like See's Candies, but sell it in a panic because of a temporary dip in the stock price, thereby forfeiting the decades of compounding cash generation that would have followed. They are so focused on the flickering shadows on the cave wall, the stock price, that they never turn around to see the fire of the business itself, the source of all light and value. This is a guaranteed path to mediocre returns, high stress, and ultimately, a failure to achieve any meaningful level of financial freedom. The direct financial connection between understanding owner earnings and building real wealth is the most crucial link in this chain of reasoning. Let's make this tangible. Buffett defined owner earnings with a specific formula. Owner earnings equals net income plus depreciation and amortization maintenance capital expenditures. Let's break down why this works. We start with net income, the flawed opinion of profit. We then add back depreciation and amortization. These are major expenses on the income statement, but they are asterisk, non-cash expenses. You don't write a check for depreciation. It's an accountant's estimate of how much your assets have worn out over the year. Since no cash actually left the building, we have to add it back to get to a true cash picture. So far, we have a rough measure of the cash the company generated. But this is where the genius comes in. Buffett recognized that even though depreciation is a non-cash charge, there is a very real time cost associated with assets wearing out. You have to spend real money, capital expenditures or CapEx, to repair and replace them. So the final, crucial step is to subtract the amount of cash the company needs to spend each year just to stay in the same place, to maintain its physical plant and competitive position. This is maintenance CapEx. The resulting number, owner earnings, is the single most important number for a value investor because it represents the true dividend capacity of the business. A company's board can decide to pay any dividend it wants in the short term, even borrowing money to do so. But over the long term, a company cannot pay out more in dividends than it generates in owner earnings without liquidating itself. This number is the fountain from which all shareholder returns spring. What can a company do with its owner earnings? It can pay it out directly to you as a dividend. It can use it to buy back its own stock, which increases your percentage ownership of the business and the value of your shares. It can use it to pay down debt, making the company safer and more valuable. Or it can retain the cash and reinvest it in new growth projects, expanding the business's future cash-generating power. A management team's skill in this process of capital allocation, of deciding what to do with the annual owner earnings, is the ultimate determinant of long-term shareholder returns. When you buy a stock, you are not buying a ticker symbol. You are buying a claim on that company's future stream of owner earnings. The price you pay for that stream versus the size of that stream determines your return. That's it. That is the entire game of investing, stripped down to its first principles. Net income is the distraction. Owner earnings is the prize. We have established the what and the why. We understand the lie of net income and the truth of owner earnings. Now we must roll up our sleeves and become mechanics. It is time to move from the philosophical to the practical, to learn the precise step-by-step process of calculating this all-important number for ourselves. This is where theory meets reality, where we transform from passive consumers of financial information into active forensic analysts. An abstract understanding is good, but the confidence and clarity that come from doing the work yourself is what builds true mastery. Our foundational anecdote for this pillar is not about a single grand investment, but about the painstaking, detail-oriented process that preceded all of them. It's the story of a young Warren Buffett, not as a celebrated oracle, but as a determined financial detective. In the 1950s and 60s, long before he was a household name, Buffett ran his investment partnership from a small office in Omaha. His primary tool was not a computer, but the voluminous, text-heavy manuals from Moody's and Standard & Poor's, which contained the financial statements of thousands of public companies. His partners would describe him as a human data processing machine, sitting for hours on end, poring over balance sheets and income statements, pencil in hand, scrawling notes and calculations in the margins. One of his most famous early investments was in American Express in the mid-1960s, following the salad oil scandal. A major customer of American Express's warehousing division had defaulted, having secured loans against tanks of what turned out to be mostly seawater instead of salad oil. The market panicked, thinking the potential liabilities would bankrupt American Express. the stock plunged over 50%. While Wall Street was reacting to the headline, Buffett did the work. He went out and observed the company's actual business. He visited restaurants and banks, talking to cashiers and tellers, observing customers continuing to use American Express credit cards and traveler's checks. He saw that the underlying business, the part that actually mattered, was completely unharmed by the scandal in the warehousing division. But his conviction came from the numbers. He went through years of their financial reports, deconstructing their earnings. He would have mentally performed the owner earnings calculation. He added back the non-cash charges. He meticulously estimated the true, minimal capital expenditures required for the traveler's check and credit card businesses to operate. What he discovered was a phenomenal enterprise with a powerful float business model, gushing cash far in excess of what was needed to run the company. While the market was panicking about a one-time loss and its impact on reported net income, Buffett was calmly calculating the immense, ongoing owner earnings power of the core franchise. He invested 40% of his partnership's capital into the stock, an act of supreme confidence born not of gut feeling, but of rigorous first-hand analysis. The investment was a spectacular success, forming a key part of his early legend. This story teaches us that true investment conviction is not found in analyst reports or market sentiment. It is forged in the quiet, diligent work of dissecting the financial statements for yourself. The psychological principle that this mechanical process helps us harness is the powerful force of cognitive dissonance reduction. Cognitive dissonance is the mental discomfort experienced when holding two or more conflicting beliefs or values. For an investor, the dissonance often lies between, "I believe this is a great company," and "the details of the financial reports are complex and I don't fully understand them." This is an unstable and stressful state. The easiest way to resolve this dissonance for most people is to simply ignore the complexity, to avoid the hard work, and to base their belief on simpler things like the brand's reputation or the stock price's recent performance. However, by engaging in the direct, tactile process of calculating owner earnings, we force ourselves to resolve the dissonance in a more productive way. The act of finding the numbers, of plugging them into the formula, and of arriving at a concrete answer makes the abstract concept of the company's profitability real and personal. It solidifies our understanding. This process also serves as a powerful antidote to analysis paralysis. The sheer volume of financial data available today can be overwhelming, leading many investors to throw up their hands and do nothing. A clear, step-by-step process like calculating owner earnings provides a defined path through the jungle of data. It gives you a specific mission, a tangible goal. It turns an overwhelming task into a manageable one. Taking this small, concrete action, doing the calculation, builds a sense of competence and control, which is the psychological foundation for making rational, unemotional investment decisions. So let's build the blueprint. We will call it the three-statement forensic audit. It is a step-by-step mental model for calculating owner earnings for any company you wish to analyze. You will need the company's most recent annual report, specifically the three main financial statements: the income statement, the balance sheet, and the cash flow statement. Step 1. Find your starting point, net income. This is the easiest part. Go to the income statement, look all the way at the bottom. The number labeled net income or net earnings is your first input. Write it down. Step 2. Find your add-backs, depreciation and amortization, D&A. For this, you will turn to the cash flow statement. It will be one of the first line items under the section Cash Flow from Operating Activities. The company explicitly tells you this number. It represents the non-cash charges that were subtracted to arrive at net income. Add this number to your net income figure. At this point, you have what is often called operating cash flow before changes in working capital, a rough measure of the cash generated by the business's core operations. Step 3. This is the most difficult and most important step, the one that separates the serious analyst from the amateur. You must estimate maintenance capital expenditures. Companies report a single number for capital expenditures, or purchases of property, plant, and equipment, on their cash flow statement. However, This number lumps together two very different things: maintenance CapEx, the money spent to keep the business running as is, and growth CapEx, the money spent to expand the business. To calculate owner earnings, we only want to subtract the maintenance portion. So how do we find it? Companies don't break it down for you, so we have to be detectives. There are several methods. The Buffett method, simple. For a mature, slow-growing company, you can assume that over a long period, say 5 to 10 years, the total capital expenditures will be roughly equal to the total maintenance CapEx needed. You can take an average of the last few years' CapEx figures as a reasonable proxy. The Greenwald method, more precise. For a company that is growing, this is a more accurate approach developed by Columbia Business School professor Bruce Greenwald. First, you calculate the company's ratio of property, plant, and equipment, PP&E, to sales for the previous year. You find PP&E on the balance sheet and sales on the income statement. Let's say it's 0.5, meaning the company needs 50 cents of PP&E to generate $1 of sales. Then you look at the growth in sales for the current year. If sales grew by $100 million, you can estimate that the growth CapEx needed to support that was $100 million times the 0.5 ratio, or $50 million. You then take the company's total reported capital expenditures for the year and subtract this calculated growth CapEx portion. The remainder is your estimate for maintenance CapEx. This is the number you subtract from your subtotal from step 2. The final number you are left with is your thoroughly calculated defensible estimate of owner earnings. You have done the work. You have found the truth. The path of the 99%, the antithesis to this diligent work, is the path of the plug-and-chug investor. This investor understands that PE ratios might be flawed, but their response is not to do the work themselves, but to find another, slightly more sophisticated, pre-packaged metric. They might go to a financial data website like Yahoo Finance or Google Finance and look for a number called free cash flow. They see this number, assume it's the same as owner earnings, and use it for their valuation. This is a dangerous shortcut. The standard definition of free cash flow, used by these websites, is simply cash flow from operations minus all capital expenditures. It makes no distinction between maintenance and growth CapEx. This can be wildly misleading. For a company that is investing heavily in a new factory or a new product line, a potentially wonderful use of shareholder capital, the standard free cash flow calculation will make it look terrible. It penalizes growth. Conversely, for a company that is neglecting its business and not spending enough to maintain its equipment, the standard free cash flow figure might look fantastic, masking the fact that the business is slowly liquidating itself. The plug-and-chug investor, by relying on these third-party one-size-fits-all calculations, sacrifices the most crucial part of the analysis, the judgment required to estimate maintenance CapEx. They have outsourced their thinking. They feel like they are being more sophisticated than the PE ratio crowd, but they are still living in the world of prepackaged data, still avoiding the essential work of a true business analyst. This is a subtle but critical failure of process that leads to just as many errors as relying on net income alone. The direct financial connection of performing this calculation yourself is that it gives you a uniquely powerful lens for comparative analysis. Let's put our new tool to work with a concrete example. Consider two industrial companies, Industrial Co. and Textile. Both are in mature industries. Both have a market capitalization of $10 billion. Let's analyze 1 year of their performance. Industrial Co. reports net income of $800 million. Textile also reports net income of $800 million. Based on net income, they have an identical PE ratio of 12.5. They look equally attractive. Now, let's do our forensic audit. For Industrial Co., we find D&A of $400 million. We look at its historical CapEx, see that it's a stable business, and estimate its maintenance CapEx is equal to its total reported CapEx of $500 million. The owner earnings calculation is $800 million. net income, plus $400 million, D&A, $500 million, maintenance capex, equals $700 million. Now for textile. It also has D&A of $400 million. But we dig into its reports and discover it operates in a highly competitive industry that requires constant, expensive technological upgrades to its mills just to stay competitive. Its maintenance capex is a staggering $1 billion per year. The owner earnings calculation for textile is $800 million net income plus $400 million D&A, $1 billion maintenance capex equals $200 million. So here is the truth revealed by our analysis. Both companies are priced at $10 billion. Industrial Co. is generating $700 million in real cash for its owners each year. Textile is generating only $200 million. As a potential owner, which stream of cash would you rather buy? For the same $10 billion price, you can get a 7% annual cash return from Industrial Co., $700 million per $10 billion, or a 2% annual cash return from Textile, $200 million per $10 billion. The choice is not just clear, it's overwhelming. Yet an investor relying on net income would have seen them as identical. This is the massive financial advantage your newfound skill provides. It allows you to see the true cash-generating engine of a business, hidden beneath the surface of the standard accounting reports. This is how you avoid value traps, companies that look cheap on a PE basis but are actually terrible businesses, and how you identify the true, durable cash kings that will form the foundation of your long-term portfolio growth. We have defined the concept, we have learned the mechanics of the calculation. Now we arrive at the heart of the matter: application and interpretation. A tool is only as good as the hands that wield it. Knowing how to calculate owner earnings is one thing. Knowing what to do with that number, how to use it to make intelligent capital allocation decisions, is the skill that truly builds wealth. This is the litmus test that separates a mere number cruncher from a wise investor. We must learn to translate our calculation into a definitive judgment on a company's quality and value. Our foundational anecdote for this pillar is perhaps Buffett's most famous and most successful investment, a masterclass in using a cash-based analysis to identify an extraordinary business at a fair price. His purchase of Coca-Cola stock in 1988. By the late 1980s, Coca-Cola was already one of the most recognized brands on earth. The stock had performed well, and most on Wall Street considered it to be fully valued, if not expensive. It was not a forgotten, cheap, cigar butt stock of the type Buffett was famous for in his early days. But Buffett, applying his owner earnings lens, saw something that the rest of the market was missing. He saw a business that was not just good, but near perfect in its economic characteristics. He analyzed the business model. Coca-Cola didn't own bottling plants or delivery trucks. It primarily sold syrup concentrate to its bottlers. This meant it was an incredibly capital-light business. He would have gone through the financial statements, performing the exact calculation we have just learned. He would have started with net income. He would have added back the relatively small D&A charge. And then he would have come to the crucial step: maintenance capex. For a business that sold syrup, the required reinvestment to maintain its position was almost comically small relative to the cash it was generating. A few labs, some office buildings, and that was about it. The vast majority of its value was in its brand, an intangible asset that sat on the balance sheet for virtually nothing but was worth tens of billions of dollars. When he finished his calculation, the owner earnings number he arrived at must have been staggering. It would have been a massive percentage of the company's revenue, a gusher of cash that required very little to be plowed back into the business just to keep it going. He then compared this huge stream of owner earnings to the total market value of the company. This calculation, which we will call the owner earnings yield, was the key. He saw that he could buy this incredible, dominant global business for a price that represented a very high cash yield, likely far better than the yield on long-term government bonds at the time. While others were looking at the PE ratio and shrugging, He was looking at the owner earnings yield and realizing it was one of the best investment opportunities he had ever seen. He invested over $1 billion, representing a huge portion of Berkshire's portfolio at the time. He wasn't buying a stock. He was buying a perpetual annuity of cash, backed by the taste buds of billions of people. This investment in Coca-Cola became a cornerstone of Berkshire's success, a testament to the power of looking past conventional metrics to understand the true, underlying cash-generating economics of a business. The psychological principle at play here is a deliberate and strategic overriding of the availability heuristic. This heuristic is a mental shortcut where our brains judge the likelihood of an event or the value of a thing based on how easily examples come to mind. For most investors, the most available pieces of information are the stock price, its recent trend, and the P/E ratio. These are the data points that are constantly flashed on screen, discussed in articles, and displayed on brokerage platforms. Our brains naturally gravitate towards using these easily available but often misleading data points to make decisions. The act of calculating owner earnings and then, crucially, converting it into an owner earnings yield is a form of mental discipline. You are consciously forcing your brain to ignore the readily available low-quality information and focus on a self-generated, high-quality piece of data. You are making the owner earnings yield the most available heuristic for your decision-making process. It becomes your new anchor. Instead of asking, is the P/E ratio high or low? Your mind is rewired to ask, is the owner earnings yield attractive compared to other investments and the risk-free rate? This rewiring of your default mental shortcuts is a profound step in your development as a rational investor. It replaces a system based on market noise with a system based on business reality. Let's formalize this into an applied mental model, the yield comparison blueprint. This model turns your owner earnings calculation into a clear buy, sell, or hold decision. Step 1. You have already calculated the company's annual owner earnings. Let's say it is $1 billion. Step 2. Find the company's current market capitalization. This is the total value of all its shares, easily found on any financial website. Let's say it is $12 billion. Step 3. Calculate the owner earnings yield. You simply divide the owner earnings by the market capitalization. In our example, $1 billion divided by $12 billion equals 8.3%. This 8.3% is the pre-tax cash return the business generated for its owners that year relative to its market price. Step 4. This is the crucial step of interpretation. You must compare this yield to your alternatives. First, compare it to the risk-free rate of return. Look up the current yield on the 10-year U.S. Treasury bond. Let's say it's 3%. The government is offering you a guaranteed 3% return. The business you are analyzing, with all its inherent risks, competition, changing technology, management error, is offering you an 8.3% cash return. Is that extra 5.3% a sufficient risk premium to compensate you for the uncertainties of owning a business? This is the core question of value investing. Step 5. Compare the yield to other potential investments. If you are analyzing 5 different stocks, calculate the owner earnings yield for each. This allows you to rank them on a consistent, cash-based metric. It forces you to think in terms of opportunity cost. An investment that offers a 6% owner earnings yield might seem good in isolation, but it's not a good use of your capital if there's an equally safe business available that offers a 10% yield. This blueprint provides a rational, disciplined framework for capital allocation, ensuring that you are always deploying your money where it can generate the highest real cash return for the level of risk you are taking. The antithesis of this disciplined, yield-based approach is the behavior of the price chaser. This individual represents the most primal and ultimately self-destructive tendencies in the market. The price chaser's decision-making process is devoid of any fundamental analysis. Their sole input is the movement of the stock price itself. They buy a stock for one reason and one reason only, because it is going up. Their actions are driven by the most powerful emotional drivers in finance: greed and FOMO. They see a stock like Tesla or Nvidia soaring day after day, and they are terrified of being left out of the easy money. They don't know the company's owner earnings, its net income, or its debt levels. They don't care. They are not investing in a business, they are betting on a line on a chart. This strategy of momentum can seem brilliant during a bull market. The price chaser feels like a genius as their portfolio swells. But they are playing a game of musical chairs with an unknown number of seats. They have no anchor of value. Their only signal to sell is when the price starts to go down, which often means they are selling in a panic long after the smart money has departed. When the narrative around their high-flying stock changes, when the growth story falters, the price plummets. The price chaser is left holding a massively overpriced asset with no underlying cash flow generation to support its valuation. They have no tools to determine if the stock is now cheap or still expensive. Their only framework was the price trend, and that has turned against them. This path is a surefire way to experience exhilarating highs and devastating lows, but it is a statistically guaranteed way to underperform the market over the long term and completely destroy any chance of achieving financial freedom. It is the purest form of speculation masquerading as investing. The direct financial connection between using the owner earnings yield and achieving your long-term goals of portfolio growth and wealth management is profound. A portfolio constructed using this principle is, by its very nature, a collection of high-quality cash-producing assets purchased at reasonable prices. This creates a powerful two-pronged engine for returns. First, you have the potential for capital gains. By buying businesses when their owner earnings yield is high, which is the same as saying their valuation is low, you position yourself to profit as the market eventually recognizes the true cash-generating power of the business and re-rates the stock to a higher valuation, causing the price to rise. This is the classic value investing play, but there is a second, more certain source of return. It is the cash itself. The owner earnings generated by the companies in your portfolio are real. They are used by management to create value for you, the shareholder, even if the stock price goes nowhere for years. They can be used to pay you dividends, providing a direct cash return on your investment. They can be used to buy back shares, which is a tax-efficient way of increasing your ownership stake in the business and boosting future earnings per share. Or they can be wisely reinvested by management into projects that will grow the company's future owner earnings, creating a compounding effect. A portfolio of high-yield owner earnings businesses is a defensive and offensive machine. It is defensive because your investments are backed by real, tangible cash flow, providing a floor to their value. It is offensive because that same cash flow is actively working to grow your wealth through dividends, buybacks, and intelligent reinvestment. This is the slow, steady, and certain path to building a fortune. It is not about chasing fads. It is about systematically acquiring streams of cash at a discount. That is the ultimate secret to beating the market and securing your financial future. We have now traveled far. We have exposed the illusion of net income, defined the truth of owner earnings, mastered the mechanics of its calculation, and learned how to apply it to make rational investment decisions. But to stop here would be to mistake the map for the territory. The calculation, as powerful as it is merely a tool. The true transformation, the final and most important step, is to internalize the philosophy behind the number. It is to move beyond being an analyst of numbers and to become an owner in mindset. The owner earnings calculation is the gateway to a more profound way of thinking about business and investing, a holistic perspective that views companies not as tickers on a screen, but as living, breathing organisms whose purpose is to generate sustainable cash. This final pillar is about elevating the concept from a formula to a complete investment philosophy. Our final foundational anecdote is one of the most charming and illustrative stories in the Buffett legend, his acquisition of the Nebraska Furniture Mart in 1983. This was not a deal done by teams of investment bankers in a New York skyscraper. It was a deal done in Omaha, based on a 1.5-page contract with a woman who couldn't read or write, the indomitable Rose Blumkin, known as Mrs. B. Mrs. B had started the business in a basement in 1937 with a $500 loan. By the 1980s, it was the largest home furnishing store in North America, doing hundreds of millions of dollars in sales from a single location. Her business philosophy was simple and ruthless: sell cheap and tell the truth. Buffett had observed her business for decades. He saw a company with a fanatical customer base, a low-cost operating model that competitors couldn't match, and a manager with an almost supernatural drive. When he decided to buy the company, he didn't send in a team of auditors to perform complex financial modeling. He sat down with Mrs. B. He knew that the accounting numbers, while useful, could never capture the true essence of the business. The true owner earnings power of the Nebraska Furniture Mart was not just in its cash flow statement. It was in Mrs. B's character, in the trust she had built with her customers, and in the company's unassailable competitive moat. Buffett paid $60 million for a 90% stake in the business. He didn't quibble over the details. He didn't need to. He understood the owner's mindset. He knew that a business with these qualitative characteristics, this secret sauce, would be a cash-generating machine for decades to come, far beyond what any spreadsheet could predict. He saw the business through the eyes of an owner, recognizing that the source of its value was not in its reported earnings, but in its enduring competitive advantages that produced those earnings. The calculation of owner earnings is what gets you to the door, but it is this qualitative owner's mindset that gives you the wisdom to know when to turn the key. The deep psychological principle that this mindset cultivates is the crucial distinction between the inside view and the outside view, a concept popularized by the psychologist Daniel Kahneman. The outside view is the default for most investors. It involves looking at a situation and basing your judgment on statistics and comparisons to similar situations. This is what you're doing when you look at a stock's P/E ratio and compare it to the industry average. It's an analysis based on external data points and analogies. The inside view, in contrast, involves immersing yourself in the specific details of the situation, trying to understand the unique causal chains at play, and forecasting the future from within the system. Adopting the owner's mindset is a deliberate shift from the outside view to the inside view. You are no longer asking, how do retail stocks typically perform in a recession? Outside view. You are asking, how will this specific company with its unique brand, cost structure, and management team navigate the challenges of a recession? Inside view. The owner earnings calculation is a quantitative tool that helps facilitate this shift. It forces you to engage with the specific capital needs and cash-generating dynamics of the business. This focus on the internal plumbing of the company is a powerful defense against the simple and often wrong narratives and statistical generalizations that drive the decisions of the 99%. It allows you to see the unique reality of a business, which is where all true investment insight is found. To make this highest level of thinking actionable, we need a final mental model, the CEO for a day blueprint. After you have calculated owner earnings for a company and determined that its yield is attractive, you must perform this final qualitative check before investing. Step 1. Imagine you have just been appointed the CEO of this company. The board has given you a single mandate: to wisely allocate the annual owner earnings for the maximum long-term benefit of the shareholders. Step 2. You look at the pile of cash that represents the year's owner earnings. What are your options? You can reinvest it back into the business to pursue growth opportunities, growth CapEx. You can acquire a competitor to expand your market share. You can pay down the company's debt to make it financially stronger. You can return the cash to the owners by buying back shares. Or you can pay it out as a dividend. Step 3. Now you must act as a critic. Look at what the actual management of the company has been doing with their owner earnings over the past 5 to 10 years. Read their shareholder letters and annual reports. Are their decisions aligned with what you, as the hypothetical intelligent CEO, would have done? Have they been buying back stock when it was cheap or when it was expensive? Have their acquisitions been successful and integrated well, or have they been costly failures? Have they been reinvesting in projects with high rates of return, or have they been squandering cash on pet projects with poor economics? This final step is crucial. A wonderful business that generates enormous owner earnings can still be a terrible investment if it is run by a management team that makes poor capital allocation decisions. A great business with a great management team is the holy grail of investing. This mental model elevates your analysis from a static snapshot of a company's profitability to a dynamic assessment of its long-term value creation potential. The antithesis of the owner's mindset is the story stock investor. This is perhaps the most seductive and dangerous path in all of finance. The story stock investor falls in love with a narrative. They are captivated by a visionary CEO, a world-changing technology, or a revolutionary business model. The story is so compelling that it completely supplants any need for financial analysis. They invest in concepts, not in businesses. They will tell you, this company is going to cure cancer, or this company is the future of transportation. When you ask them about the company's cash flow or its path to profitability, they will dismiss your concerns as short-sighted. They will say, you just don't get it. They are investing in a dream. Think of the dot-com bubble, where investors poured billions into companies with exciting stories but no revenue and no hope of ever generating owner earnings. Think of the more recent bubbles in speculative tech, where companies with billion-dollar valuations were burning through hundreds of millions of dollars in cash each year. The owner's mindset is the perfect antidote to this trap. An owner, by definition, is concerned with cash. A business that does not and cannot generate cash is not a business. It is a hobby or a speculation. The ruthless focus on owner earnings acts as a filter, protecting you from the most enchanting and most destructive force in the market, a beautiful story untethered from economic reality. It ensures that your portfolio is built on a foundation of profitable businesses, not just hopeful narratives. The direct financial connection between this final mindset and the ultimate goal of financial freedom is the most powerful of all. Building a portfolio is not just about accumulating assets. It is about becoming a master of capital allocation. When you adopt the owner's mindset, you begin to see your entire portfolio as a single enterprise, a U Inc. The money you invest is your capital. The stocks you buy are your acquisitions. The owner earnings generated by your portfolio companies are the cash flow of your personal holding company. This perspective transforms everything. You are no longer a passive participant in the market. You are an active business owner, deploying your capital with the same discipline and rationality you demand from the CEOs of the companies you own. Over time, this approach leads to the magic of compounding. Your collection of cash-producing businesses will generate more and more cash. You can use those dividends, the owner earnings paid out to you, to acquire more cash-producing assets. The companies you own will use their retained owner earnings to grow their own operations, making your ownership stake even more valuable. This creates a virtuous, self-reinforcing cycle of wealth creation. This is how true, lasting, multi-generational wealth is built. It is not through frantic trading or by chasing speculative fads. It is through the slow, patient, and methodical accumulation of ownership stakes in wonderful businesses, purchased at sensible prices. It is the final and most profound promise of value investing, the transformation from a mere investor into a true owner, a journey that begins with a single, honest calculation and ends in a state of genuine and enduring financial freedom. You have just completed a deep dive into one of the most powerful mental models in finance. You now possess a tool, the owner earnings calculation, that the vast majority of market participants have never even heard of, let alone mastered. You have acquired a lens that cuts through the fog of corporate accounting and reveals the bedrock truth of a business's cash-generating power. This is no small thing. This is a permanent upgrade to your analytical arsenal, a shield against hype and a sword for finding true, unrecognized value. But this tool, as powerful as it is just one instrument in the orchestra of a complete investment philosophy. It is a critical piece of the puzzle, but it is not the whole puzzle. Knowing what cash a business generates is the essential first step. The next and arguably more critical question is understanding the quality and durability of that cash flow. It's the difference between owning an oil well that will gush cash for 10 years and then run dry, and owning a toll bridge that will reliably collect cash for 100 years. This is the concept of the economic moat, the sustainable competitive advantage that protects a company's profits from the relentless forces of competition. The video that is about to play on your screen is the next piece of that map. It is the key to understanding that very distinction. It is the bridge that connects the quantitative analysis of owner earnings, which you have just mastered, to the qualitative analysis of a truly great business. It is the link that explains how to ensure the cash stream you found is not a temporary fluke, but an enduring river of wealth that will compound for decades. You have proven by watching this far that you are not a passive observer, you are an analyst. You are building the mindset of an owner. The choice to click is not about watching another video. It is a commitment to completing your mental arsenal, to moving from just being an investor to becoming a master of capital allocation. It is the next logical step on your ascent. Continue the journey.